Hey everyone, welcome in to another edition of Market Takes. It is a beautiful day to dissect some economic data. The sun is shining, the birds are chirping, and I know you could have been anywhere in the world, but you are here with me, and I appreciate that. I am Dion Rabouin, reporter at the Wall Street Journal. Today we are diving into unpacking, explaining the CPI Consumer Price Index report. CPI just came out this morning. The markets are having a reaction in a pretty big way. I think the reaction we've seen, especially on the stock prices, from the stock markets and from commodities, has been very interesting. So we're going to get into what all that was and why all that was here in just a sec. But of course, we're going to talk about what the CPI report said, break down what those headline numbers were, as well as get under the surface and explain how those numbers compared to expectations. We're also going to talk about the biggest takeaway. I think there's one big takeaway you can get from today's report in terms of looking at all the other data that we've seen. We're of course going to talk about how this report changes or moves expectations for what we think the Federal Reserve is going to do next, or at least what investors think the Federal Reserve is going to do next. We're going to take a look at the markets. Like I said, we're going to talk stocks, bonds, commodities. We're going to talk a little bit about those currency markets as well. So stay tuned for that. And we're going to explain what today's report tells us about the future and what to look for next. So without further ado, let's get into it. The CPI report today showed 4.9% year-over-year inflation in April, as well as a 0.4% increase in inflation month over month. So as you look here, this is the year-over-year chart that we've got up here right now on your screen. And you can see we've seen inflation consistently come down since that peak in June when inflation at 9%. It's been coming down, and this month we had 4.9%. Last month it was 5%. The month before that it was 6%, going all the way back up. And you see that consistent downturn in CPI inflation, and you see it's been coming down. That's what the market wants to see. That's what the Federal Reserve wants to see. And this had been right along with expectations for 5% year over year, a little bit below that at 4.9%. 0.4% month over month, right on the numbers. Now, I want to put this other chart up here on your screen, and that is the core consumer price index. That's when you strip out food and energy prices, which are very volatile. So the Fed likes to see, okay, what's happening at the core of the market or of the economy right now with inflation. And as you look, you see those numbers not quite moving along the same trajectory. You see a consistent downturn since June in terms of the numbers moving lower. But then the last few months, we saw a pickup last month. Core inflation actually rose to 5.6% year over year last month. And this month in April, coming in at 5.5%. So core inflation being a bit more stubborn than the overall inflation in terms of coming down. And that's maybe got some folks on the market side worried. So it's got some folks on the market side a little worried, I should say, and this illustrating that trend that we have seen overall in markets. So what we've got is the core CPI when you take out shelter. Core CPI services ex shelter, that's the super core metric, that also decreased to 0.266% month over month, down from 0.294% month over month last month. All those numbers mean is that what the Fed has said is the most important thing to watch now. Core, super core inflation, or super core CPI inflation. It's a mouthful. What the Fed has said to watch, that super core number has been coming down while overall inflation's coming down, core coming down just a little bit at the margins, but coming down. Everything kind of moving in the right direction, the direction that the Fed wants to see it in. That's got markets a little bit excited. Now, when we talk about what's moving up and what's moving down in this report, because not everything moves in the same direction as the overall index, right? So we saw transportation services down month over month, medical care services down month over month. So overall, the services reading on this CPI number moved lower, but it's still up year over year. So month over month, the trend is coming down, but year over year, we see we are still up and still higher. I want to get into the context, the nuts and bolts, just a little bit more. I want to read you a quote from Goldman Sachs Asset Management this morning. They said, quote, "The below 5% headline CPI number is a sigh of relief to a market on edge. The data today will be interpreted as not hot enough to force the Fed's hand in June. The Fed has an excuse now not to hike. In fact, the market's first reaction is to price that the Fed will be done." And I think we're seeing that in markets. Going to talk about that in just a second. So listen, one thing I saw a very interesting quote in my inbox this morning. It said, "This report confirms CPI is trending as expected." What does that mean? Well, that's bullish. That means the markets, there's not a new worry introduced to the markets. There's not, anything that's, oh goodness, now we got to worry about inflation picking back up or moving in a direction we didn't didn't expect. Market is pricing that inflation is going to get back down towards or close to the Fed's 2% target by the end of the year. That's been priced in, and that's what you're seeing in the stock market and the bond market is expectations for that to happen. So for this report to come in as expected, you were seeing a continuation of those themes. What's driving inflation? We saw a huge jump in used car prices, up 4.4% over the month. 4.4% month over month is a big, huge number, and we know how much used car prices moved the CPI figures last year and coming into the start of, well, actually really at the end of 2021 and into 2022, and then that has started to fade away. So used car prices have not been as much of an increase or a push up on overall inflation. We saw a big jump in that number. The index for shelter was the largest contributor to the monthly all items increase. This is straight from the BLS's report, followed by increases in the index for used cars and trucks and the index for gasoline. So we know that all of those things, if we look at the real-time indicators and if we look at the consistent trends, have been moving lower. So the fact they picked up 1 month, well, the market's saying, okay, that may be a 1 month aberration. That might just be happening this month. We don't think that's going to continue. And so that's, again, good news for this overall inflation theme. Now, if we see gasoline prices continue to pick up, if we see used car prices continue to pick up, that might be worrisome for the market because these are worries that we thought we were done with, that we thought, oh yeah, that's in the past. And so investors are really kind of looking past those increases and saying, overall, this is a good thing. Now, a big piece of this could be the index for gasoline. The increase in the gasoline index more than offset declines in other energy component indexes, and the energy index overall rose 0.6%. All that means is that overall you've got energy picking up, even though fuel oil, natural gas, things like that declined, diesel. Overall gasoline prices increased. What we're seeing at the pump is rising, and that has a big impact on consumer psyche. Folks, when they see those prices rising at the pump, they think, oh man, inflation might be coming back. Prices are going to rise. I need to demand more at work. I need to try and get a raise because I've got to keep up with these overall inflation prices. I was just in Phoenix recently, saw gas prices over $5 a gallon just a couple weeks ago in Phoenix. The U.S. average is $3.53 a gallon versus $3.60 a month ago versus $4.37 a year ago. So again, trend moving in the right direction, but it remains to be seen whether that will continue. We've also got the food index being unchanged. We know that food has been a big consistent part of this overall inflation story. Food was unchanged in April. Again, it was unchanged in March as well. Index for food at home declining. That had been something that had been really spiking up. What you're paying at the grocery store had been picking up on a big level. That's going down this month. While the index for food away from home rose 0.4%. Index for airline fares, the index for new vehicles were among those that decreased. So airline prices getting a little bit cheaper. That's good to see as we approach those summer flying months when a lot of Americans do traveling. Listen, one thing that we don't want to forget, and one thing that I pointed out in our look ahead earlier this week, was corporate profits. Corporate profit margins are on pace to increase for the first quarter. Once we get all those earnings reports, we will know whether corporate profits picked up and increased again. Right now, it looks like they will. And that was a huge driver. In fact, the main driver of overall inflation increases that we saw last year that led to that big 9% increase year over year. We are seeing right now S&P net profit margins, which means the amount of profit that companies are making for every dollar of sales, increased. It's on pace to rise the first quarter in 6 quarters. It decreased 6 straight quarters, and now it's expected to increase if we continue on this trajectory. It's up 11.5% from what it was a year ago. Now, keep in mind that corporate profit number, corporate net profit margins up 11.5%. That compares to 4.9% overall inflation and 2.7% increase in producer prices, aka wholesale prices, or what companies are paying. So companies' prices are increasing at about 2.7%, and their net profit margins are increasing 11.5%. That puts more upward pressure on inflation. That's something you're going to want to keep an eye on, is the role that company profits play in inflation. The oil companies as well have seen big profit margin gains, and that could be part of why prices at the pump are still high, even though overall oil prices have declined pretty significantly. Keep your eye on that, and that's why you want to watch out for those reports, those earnings reports from oil companies, because even though oil prices are declining and coming down from their highs, oil companies are just keeping prices high, keeping that difference as profit. So let's take a step back now and talk about expectations for the Federal Reserve. The market very clearly after this report came out was betting that the Federal Reserve is going to pause at its June meeting and then start cutting rates again soon. And an interesting development in the Fed funds futures market, we're seeing an increasing bets on a rate cut in July. Folks had really been betting the Fed was going to start cutting rates in September, and that was sort of the move that was priced in. But after this CPI report came out, we saw a move in Fed funds futures prices showing a 36% likelihood of a cut in July. All that means is that folks think that, okay, with inflation slowing down, even though it's still more than double the Fed's 2% target, folks are betting that in just a couple months, we could see a Fed rate cut as soon as July. 36% chance of that. And if you go out to September, you're seeing a rate cut fully priced in with a 22% chance of 2 rate cuts as soon as September, or a 50 basis point rate cut. Basically the Fed cutting the equivalent of 2 rate cuts, or maybe cutting in July and again in September. That is big for the market because it not only signifies that folks don't believe what the Fed says. Remember, the Federal Reserve, Fed Chair Jerome Powell said, we are not cutting rates. We are going to keep rates elevated. Even though we may be pausing for right now, we are going to keep rates at this high level through the end of the year, or maybe even raise them if inflation starts to pick back up. The market's saying, not only do we not believe you, we think you're going to start cutting, and we think you're going to start cutting soon. The rubber is going to meet the road here very quickly. The Fed, if they're going to cut in July, is going to have to signal that in June. We could see some big market moves in June or in July. So watch this space, as I like to say. That is holding stock prices up because folks expect, okay, companies are having a tough time now, but we think that things are going to change pretty soon, and that could push those stock prices up. So we're not going to sell, we're not going to get out of stocks. It's also pushing those bond yields down, making it cheaper for companies to borrow money. Want to throw one more chart up here on your screen, and this is going to show the difference between what we're looking at in terms of big companies versus small companies. This is the net percentage of U.S. banks tightening lending standards. What that means is what percentage of banks in the Fed study are making it harder for you to get a loan, making it harder to give businesses loans, whether they're small businesses. This is more mid-size and large companies, but how tough is it to get a loan? Are you requiring higher credit scores? Are you requiring more collateral? Are you requiring a longer relationship? And this right here is showing 46% of banks are increasing those lending standards, making it harder for folks to get a loan, harder for businesses to get a loan. And we know that this affects smaller companies more than bigger companies. So while conditions have been easier for large companies that can issue stock or issue bonds out on capital markets, conditions have gotten significantly tighter and more difficult to get money for these small businesses. And as we can see, we've already risen into recession-level conditions when it comes to the net percentage of U.S. banks tightening lending standards. Whenever it's gotten this tight before, as you see there on your screen, we have had a recession. So keep your eye on that. But also, it's interesting to note that we didn't get a big pickup this last we just have the reporting period in from April, and we didn't get a big pickup between April and January as we were expecting after Silicon Valley Bank collapse, after First Republic and all that. So we didn't get a big pickup there. So that just illustrates, like I said, that it's harder right now for companies to borrow money, especially the smaller ones, but not getting a lot harder as a lot of folks would expect it, as a lot of folks would have expected. Now let's talk about and let's take a look at what's going on in the markets. I want to put up here on your screen what we're seeing overall in the stock market, the bond market. Now, initially when that CPI report came out, you saw stocks open up higher. And this is the Dow Jones Industrial Average right now. And then as folks kind of digested, you saw these stock prices really drop and even went negative. And we are back up positive now just a little bit. The Dow is up about 0.1%. The NASDAQ up 1.13%. I want to show you just for context here, the 5-day chart. And you see right here, boom, just a big takeoff this morning. And that really all came after that CPI report was released. So you see a big pickup, especially on the NASDAQ, because the NASDAQ has those tech names that are much more impacted by the Federal Reserve's rate hiking cycle. And we have seen those pick up significantly. Stocks are way up for the NASDAQ. You see up 1% versus 0.5% for the S&P and just a little bit over 0.1% on the Dow. When we look out here at the bond prices, we're seeing the 30-year down a little bit, but want to take you into the yields that are much more impacted by Fed expectations. The 2-year note, you see a huge drop, and that comes right after 8:30 when we got that CPI report. bond yields going down, which means prices going up. Basically, folks saying, I want to buy bonds because I think yields are going to be lower. I think the Fed is going to cut rates. I think that inflation is going to keep coming down. And that just illustrating overall what we've seen from the markets on that side of things. You also saw similar things happening with oil prices, with copper prices. Gold actually had picked up initially after the CPI report came out and then came back down. So that was what we had seen from markets in reaction to the data we got this morning. Listen, big step back. What are we looking at? The effect on the current narrative is folks are expecting that the economy will get a little rough, the Fed will cut rates, and that will be good for especially risky stock prices and risky assets like things like oil. We expect rate cuts is what the market is saying as soon as July, pricing those in a little bit sooner than September, but there is no doubt right now in the market. The market has a 0% likelihood right now that by December, the Fed will have rates where it has them right now. I'll say it again, 0% likelihood is what the market is seeing as the Fed keeping rates at its level right now. Market is pricing in at least 3 cuts from the Fed by December, and there are some expectations now for 4 rate cuts. That's big. What's next? Well, we've got more data coming out this week. PPI, the Producer Price Index, will be out on Thursday. That's coming up tomorrow. And again, that report showing 2.7% increase year over year for producers. So that has just really come down significantly and moving towards the Fed's target for CPI, 2.2%. Now, that's important because we have seen for a long time PPI lead CPI, so you're going to want to watch that. We also get the Empire State Manufacturing Report on Monday. That usually is not highly watched, but those numbers have been so bad over the course of this year. Every report we've seen from Fed Manufacturing Survey has just been bad, negative, if not negative by 10, 20 points. It's been at least on the below zero side. So watch out for that one on Monday. If we get another very negative print, it could be an ominous sign for the overall state of manufacturing, maybe for recession expectations. We will be talking right here on Monday. Market Takes will give you your look ahead. And next week, we've got U.S. retail sales on Tuesday. We'll be talking about all that. Listen, I'm your host, Dion Rabouin, reporter at the Wall Street Journal. This has been Market Takes. I thank you so much for being with us, and I hope you'll be with us again next time.